As freight brokers, we often need to calculate prices for our customers. Now, the profit we add to the carrier cost can either be a margin or a markup. Today, we'll dive into the concepts of both margin and markup, simplifying them for easy understanding and explanation. So, what's the difference between margin and markup? Margin is the profit expressed as a percentage of the price the customer pays. On the other hand, markup represents the profit as a percentage of the carrier cost. Simple enough, right? Well, for some maybe, but many not so much. In comprehending this concept, I found it more logical to begin by examining the final outcomes of margin and markup. Though unconventional, when teaching this approach to others, they tend to grasp the concept more easily. First thing to understand is that markup and margin both revolve around three key components: customer price, cost, and profit. Using a real example, let's say you're charging your customer $1,000 and your cost is $800. Your profit in this case is $200. To find your margin in this example, we divide the profit by the sale price. 200 divided by 1,000, which gives you 0.20 or 20%. To find your markup in this example, we divide the profit by the carrier cost, so $200 by 800, which equals 0.25 or 25%. So we understand that, but what if you need to add a specific margin or markup to determine your customer's cost? Don't worry, I've got you covered. To add a margin, we use the formula carrier cost divided by 1 minus the margin percentage. So for a 20% margin on an $800 cost, we do 800 divided by 1 minus 0.20, which equals $1,000. Now, let's add a markup. We use the formula carrier cost multiplied by 1 plus the markup percentage. So for a 20% markup on an $800 cost, we do 800 times 1 plus 0.20, which equals $960. So when it comes to margin and markup, why would a company choose one over the other? A company might prefer to use margin over markup because margin-based pricing offers consistent profitability regardless of fluctuating costs. This can allow for greater pricing flexibility and easier comprehension by stakeholders. Additionally, margin-based calculations often integrate seamlessly with software systems, which can streamline pricing processes and facilitate efficient reporting and analysis. Now, a company might choose to use markup, also known as cost plus, over margin because markup-based pricing provides a straightforward approach to setting prices based on the costs of goods or services. By calculating profit as a percentage of the cost price, markup-based pricing allows for consistent profit margins irrespective of changes in selling prices. This can make it easier to manage pricing strategies. This method simplifies cost analysis and internal calculations, enabling companies to maintain a clear understanding of their profit margins and cost structures. In closing, understanding the difference between margin and markup is essential for accurate pricing and maximizing profits as a freight broker. Make sure to use the appropriate formula based on your business needs to offer competitive rates while securing a healthy profit margin. As always, we appreciate you for watching. If you enjoyed this content and you're new to LTL, check out our LTL playlist where we offer several videos reviewing the reasons you should have LTL in your book of business to handling LTL disputes. Also, please like, comment, and subscribe, and we'll see you next time.